All right, I'm really excited today. I got about 100,000 something dollars to spend picking individual stocks, and I'm talking to the right man today, Kelley Wright at IQ Trends. They got a list that they release every single month with all the undervalued stocks, overvalued stocks. I got a bunch from that list I want to talk to him about before I purchase them. They also got the Timely 10, their top 10 picks for people to be looking at. I'm super hyped. This is going to help me out a lot. So if you're a serious investor, please pay attention. This is the podcast to watch.
So the Timely 10, which is the 10 top stocks out of our undervalued category. So the first one would actually be Merck and Company, which is the large pharmaceutical company. So why did I pick it? So we have this value identification system. That's really what we do. Is we're into value identification, and we have a criteria. It's very simple, uh, and it filters out. Well, there's like over 4,000 stocks that are publicly traded. Our filter gets us down to about 300. And then we take a look at each one of those individually and we find out what the repetitive areas of high and low dividend yield are because really high quality stocks tend to trade between these two high and low dividend yield areas. So I've got about 90 stocks in my undervalued category right now. No one can invest in 90 stocks unless you're running a fund or you just have more money than you know what to do with. So, so Merck, great pharmaceutical company. It's at its low price, high dividend yield area. So that means it's undervalued. But then let's, dig down a little bit farther. Um, it's return on invested capital, which I'm not going to get into, which is a fancy word for how you watch revenue. Free cash flow yield, which free cash flow is a fancy term for profit. Um, and then the yield is found by dividing that into the enterprise value, and then the price divided by economic book value. Now, that all sounds like real complicated stuff, but it's just really cash flow measures. So in my undervalued category, Merck has the best internal cash flow measures. And you ask, why do you even worry or think about that? And here's the thing is that what we're trying to do is find the best, highest quality stocks that there are in that investable universe. And then we find out when they offer good value to buy, when you should hold them. And then at some point, yeah, you're going to sell them because you've wrung all the value out of them. All right. So we've got this really super high quality universe of stocks. And then you've got these stocks in our universe that are in the undervalued category. And it's like, why are they undervalued? That makes no sense because these are some of the best companies on the planet. And then you dig down and you find out, and it's like, oh, it's about the cash flow, meaning how much revenue are they generating based on, what they've got invested in the company? What's their profit? And then how is the market valuing them? So anyway, didn't mean to take you over the hills and through the woods, but that's what we do is we dig into this stuff. So Merck was number one, uh, and then Wyco Group, which a lot of your folks might not know. The symbol is WEYS. Very simply, they are a shoe company. They make shoes for the middle market. And it's dull, it's boring, and they have phenomenal internal cash flow numbers, and they're at their low price, high yield area. Uh, Number three would be M&T Bank, and the symbol is MTB. Um, it's what I would call a super regional. They're not like a JP Morgan or um, let's see, who's another really huge bank. They're not like a Toronto Dominion, not one of those super multinational ones. They're kind of a regional bank. Once again, they don't do anything like outworldly spectacular. They just kind of block and tackle and do regular banking stuff. But if you look at their cash flow internals, their return on invested capital, their free cash flow yield, and the way the market has them priced, it's a beautiful thing. So Those are the top three. The next one would be Kimberly Clark. Symbol is KMB. It's an old school staples company. They make diapers and all of that sort of rot. Um, yeah. Is it rocket science? No, it's staples. It's stuff that people buy all the time. They're earning 14% return on invested capital. They've got 8% free cash flow yield, and the market has them right around their economic book value. So it's a no-brainer for me. Number five would be Clorox. The symbol is CLX. Again, it's a staples company. Nothing. Look, it's not cutting edge AI. It's Clorox. They make bleach. They make a bunch of stuff, the consumers use all the time.
Really
But they're
quickly,
killing it.
really quickly, if you guys notice, I'm writing down as he's saying this. Please write down or pause and try to write these down quickly because I don't want you guys to lose this. Okay. So number one, we have Merck and Company, MRK, Waco Group. Number two, WEYS. It's a shoe company. Number three, MT&T. It's a bank, MTB. Number four, Kimberly Clark, KB, diapers and stuff like that. Number five, Clorox, CLX. Throughout this podcast, there's gonna be a lot of knowledge bombs here, and what you're mentioning is like you guys do all this intense research. You do all of this stuff, and this is why I lead it with guys. I'm so excited to be talking to you about this. I used to die inside having to do all this stuff, and after you originally spoke, and I'm like IQ trends. I'm like, holy Jesus! You reduced my workload exponentially. Where I can now just defer to your list, knowing that you guys did all that first, and I have a list because like no one can invest in the 90 undervalued, but I have specific things I look for. And I go like, are those companies on here, or there's certain things I'm looking for on your undervalued that associated with my investing style? It's like it's like having your own like research team working for you. It's crazy. Like as like a value investor, that's why I love it so much. And I want people really to pay attention. This is different than my other podcast. Like this guy's an expert. Like really pay attention here. So we're at number five. I just want to pause and let people know to like. So let's get to number six.
Yeah, no, I appreciate that. It's a company called Omnicom Group, and the symbol is OMC. Omnicom is this umbrella. Um, it's communication services. It's really advertising is what it is. And it's this giant umbrella that underneath they own about 1,500 little individual companies that specialize in various forms of advertising, whether it's digital, it's print, it's media, it's whatever. And what's really interesting about their business model is that while they're all under the same umbrella, they actually compete against each other.
Oh,
So it's a wild model. It's wildly successful. Matter of fact, they're buying their one of their competitors, which is the Interpublic group of companies. Anyway, they're at their low price area, and their high dividend yield, return on capital 13%. Free cash flow is there. But interestingly, the market's got them priced at about 30% below their economic book value, which is like,
oh, that's good.
yeah, that means you're buying assets for pennies on the dollar. You're getting it at a 30% discount. I mean, well, okay. Um, yeah, I'll do that all day long and twice on Sundays. West America Bancorp, symbol is WABC. This is an old school bank up around the wine country of California. Um, they occasionally loan money, um, only to people that don't need it. Uh, no, I mean their lending standards are ridiculous. They're very,
Good.
very tight. Um, they have a lot of depositors that are small and medium-sized companies, and they don't pay any interest on those deposits because their demand. So they've got this huge pool of capital that they can use. But what they're really, really, really good at is in securities, specifically bonds. They make more money buying and trading bonds, and it's wild. Just incredible management, super, super conservative, super risk adverse. Um, Low price. They're at their low price, high yield area. Revenues awesome, 12%, free cash flow 5. Markets got them priced at a 20% discount to their economic book value. It's like, yeah, that's just like dumb math. You know,
Yeah.
you're gonna give me something for free. Okay, I'll take it. Um, Next would be Imperial Oil. Symbol is
Yeah.
IMO. Um, Imperial Oil, yeah, uh, there's a big stake in the Imperial that's owned by Exxon. And I love Exxon, except they're way overpriced and I wouldn't spend the money on them. So it's kind of a back end way to actually be with Exxon without owning Exxon. Once again, they're at their low price, high yield area, 14% return on invested capital. Free cash flow is a little low because they're investing, they're spending money on investing. And again, they're at like a 20% discount on their economic book value. Um, Last two, Chemed Corp, CHE. It's a healthcare company. Um, Totally different. They're not into pharmaceuticals or anything like that. They're into medical devices and totally different area of healthcare than like Merck is. Uh, the return on invested capital is 21%. What does that mean? So every company has to be capitalized. Where does that money come from? Well, it either comes from stock, which is equity, or debt, which are bonds. Doesn't really matter. The point is what's the return on the money they've invested into the operating part of the business? Chemed's return on invested capital is 21%. They're making 21 cents on every dollar that they've got invested in the operating part of the company. Okay, yeah, you don't have to worry about the revenues. Uh, Last one would be UFP Industries, and the symbol is UFPI. That's an industrial company. They make building products. Um, if you know anything about, uh, residential building, apartment building, anything, we've got a huge demand and we don't have sufficient supply. And so you take a look at the big builders, like DR Horton or Pulte or Lennar or any of those companies, they got to buy their stuff that they use to build from somebody, and they get a lot of it from UFP. And once again, they're just killing it on their revenues and their profits. So that's my timely 10.
That was great. Thank you. And what? So really quickly for everyone: Merck and Company, Waco, MT&T, Kimberly Clark, Clorox, Omni, West America, Bancorp, Imperial Oil, CHE, UFPI, and now there's diversity there. That goes in some of the thesis. I know you talked. You'd like to be diverse across different industries. Let's talk a little bit about that. 'Cause I want to keep breaking down the thesis behind here. People have to understand this investment style because I love it because I feel like I don't know. I feel like this is the only way to do it. So, and by the way, he wrote a book called Dividends Still Don't Lie. Check that out. You can get it on Amazon. That's there as well. But explain sort of the importance of being diverse across different industries, because that's sort of what you do. And then sort of the boring company approach, because you've mentioned that earlier. Yeah.
Yeah, so diversification is your friend. Um, our general approach is this, Gary. We feel that the optimum portfolio is between 25 and 30 stocks, as equally diversified among the 9 or 10 different major industrial sectors as possible. And so we want to compile a portfolio of 25 to 30 stocks, all from the undervalued area, meaning they're at their low price, high yield area, and as diversified as possible because we're bottom up stock pickers. I mean we don't have a macroeconomic thesis where we sit down and gaze at our navel and go, I think that this is going to be the driving economic um, driver. And it's like, no, we don't do that. We look at what Mr. Market gives us in terms of value. Okay.
Yeah.
Um, and then so but you can't outguess Mr. Market. It's just forget about it. It's not going to happen. So you have to look and see, what the market gives to you in terms of value. and then we slowly build our portfolios from the bottom up, individual stocks as diversified as possible, from those primary sectors. And then we just hold them until they get to their high price, low yield area. Uh, because here's the thing that all of the companies that we follow have in common. And this is pretty much the same with all really high quality companies, is that they have a cycle. And the cycle goes from, a low price where their yield is high, it attracts buying, the price starts to go up. As the price starts to go up, the current yield starts to decline. And as the price rises, they become less and less attractive as the yield gets lower and lower and lower. But at some point, they reach a repetitive area of high price and low yield where the buying just dries up completely. That's it. Well, at that point, it's time to bail because you got them down here, you rode it all the way up here, plus all the dividend increases that you got along the way. And so you've wrung all the value out of the stock. And that's when you kind of plant the flag and declare victory, sell it, and then you go look for another stock in the undervalued category to replace it. So it's almost like the seasons, spring, summer, fall, winter, it rotates. You buy here, you hold through here, you sell here, rinse and repeat. And that's that's basically it.
Yeah, I don't think you can explain it much simpler than that. Because I was gonna try to get the simplest explanation out of you, of how to explain it, but that's exactly what it is. So I'll sort of run by how I'm using it right now, and I think I'm using IQ Trends the way it should be, like the monthlies. Like I got to September. I'm looking at September right now. It's because I'm in a buying phase right now, so like, I am actively looking. It's like I'm gonna pick undervalued that I want to buy, and then I just keep watching the newsletter because you have hold, and then you have I think it's sell. I think it's called sell.
Well,
Maybe it's
it's
called
called
sell.
overvalued.
Overvalued. Okay.
Yeah. Yeah.
So when it drops into overvalued, I go, that's my trigger,
Yep.
right? And
Yeah.
yeah, and that's it. And like I don't people I guess what people understand, like that's kind of hard to do when you're doing it by yourself, always watching, making sure you're exiting at the right time. And you have the criteria of when the price increases so much, the dividends minimized so
Right.
small, and it's dried up. Right. Yeah, that's the point. And you track that for me. And I go, great, exit point. I don't have to question it too much. I just know you guys had exit point. And I basically just follow your funnel. Start undervalued and sit on something until it hits and maybe it gets on my radar when I look at hold. Okay, it's on my radar now. And when it gets into overvalued, then I go, okay, I should probably start thinking about
Yeah.
selling.
When it gets to like within 10% of overvalue, that's when
Yeah.
I start paying attention because look, I've got a bunch of friends in this business. I got a lot of friends. I mean, peers. I have competitors. Everybody on the planet has a buying discipline.
Yeah.
Okay. Very few people have a true hold discipline, and
Mm-hmm.
even fewer have a sell discipline. And what I've heard, I mean, I've been doing this since, well, a long time. I'm getting old. Anyway, um, people tell me all the time, I bought this stock at X and I've held it for this long and I've got a gain, but, when do I sell it? And so we let the dividend yield tell us when to sell it because
Yeah.
we have this historical map that every time this stock gets at this high yield area, buying comes in.
Yeah.
And then every time the price goes up and it reaches its low yield area, that's when the selling comes in. So we've got these two distinct boundaries, and those boundaries are established by those millions of individual investors that don't know each other, but for whatever reason, they have all come to agree that XYZ is a great value at this yield,
Yeah.
and that all the value has been wrung out at this yield. So you don't have to play this guessing game about, oh God, I mean, I've got a 10% gain. Should I sell it and take the profits? Or, you
That's
know,
it.
yeah. So the dividend yield tells you here's when you buy, you hold it until it gets to here where you've maximized it. Boom, you sell it. take your proceeds and then go reinvest it into something else.
I think that's where I'm at. I feel like I'm good at picking undervalued stocks, but I feel like I've always, if I have a weakness, it's selling. I feel like I always sell a little too early. Like like my exit price has always been a little. I've been too conservative. I've been too, and my criteria. It's just like I I like knowing now. At least I have a secondary. I can compare where I think is a good sell price versus your sell price. I kind of like having that now because I it's been on my radar. This is a weakness of mine. I'm a little bit too a little bit like I got to exit, and maybe because I go into undervalued stocks, is a bit of like I'm taking a risk here. I went undervalued, but I think now that I even reference my pick against what your guys' pick is, there's more confidence in my pick. Like the
Mm.
UNH United Health, I wasn't too sure because of all their legal problems and all that stuff. But then when I saw it was on the undervalued list, I went, I don't know. For me, a little bit of peace of mind. I'm
Plus,
not doing.
plus, plus the revenues were there.
Yes, yes. So I did all
Yeah.
my due diligence beforehand, but it was, and that's why I actually invested. I have a breakdown of it on my website of like why I picked it. But it was as an investor, it was nice to know that you guys, your research team, all you came to the same conclusion I did. And it was like, oh, okay, this is good. And then I'm like, now I can kind of follow you guys along and track this one stock along with you guys because it's money. It's my money. I wanted many tools working for me. Like I like knowing you guys are working. Like I technically see you guys as like working with me on this. So that's why I like
Well,
it.
you see, money is an emotional thing,
Yeah.
and human beings are emotional animals,
Yeah.
and we we can get caught up of, oh, I don't want to make a mistake. I don't want to do this. I don't want to do that. And I mean, we're aware of all this. Um, we're very risk adverse, and what we're trying to do is we want to buy low risk and then hold it and maximize it, and then sell it when it gets to its higher risk area. Um, and but we don't want to do that on an emotional basis. We're trying to remove the emotion from it and say, look, here's math. It's repetitive math. Um, yeah, let's do that. And because look, I don't want to get all knotted up
Yeah.
emotionally inside. I mean, and I'm a money manager. I mean, I manage other people's money, because I have a separate company. If I was all caught up in the emotion all the time, I mean, you'd have to ship me off. And so here's a way to eliminate some of those things that plagues, the average investor, which is, oh, I don't know, should I hold it? Should I sell it? And it's not that we're trying to be greedy, uh, but I want to wring everything I can out of a position, uh, because it's hard. Benjamin Graham taught us that every time you make a transaction, you've got a 50-50 chance of doing something incredibly stupid, you
That's how
know.
it feels sometimes.
So, you know, and Benjamin Graham also taught us once you've got a great company, which for us is something that's in the undervalued area that has great
Mm.
fundamentals, don't be in such a bloody hurry to sell it. I mean, milk it, but milk it to where it makes sense. I mean, don't be a pig, and that's what we're trying to do is, and you also have to be prepared, Gary. And I'll give you a great example. In February of 2003, McDonald's hit our undervalued category. Now you got to understand something here. McDonald's had gone through a brutal period. I mean, it was just it wasn't lively in the culture. It was this old hamburger joint, yada 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 yada. And so, you had this new management that came in. They cleaned up the restaurants. They made them family friendly. They simplified the menu, which sounds weird because it's McDonald's, but they dramatically increased the dividend. And when they did that, the yield went up, and that put it in our undervalued category. And I took a look at it and I told our subscribers, I said, hey, McDonald's is a buy. And, and people went nuts. They said, Kelley, come on, man, you got to look at Starbucks. You're old. You're a dinosaur." And I said, "It's a great company. The yield is there. The revenues are there." We started buying it at $15. We bought more at 17. We bought some more at 19. Make a long story short, McDonald's raised their dividend so much, they were in the hold period for 16 years.
Oh,
Stocks that we paid an average of $17 for, we sold it almost $400. The dividend was originally 19 cents, and by the time we sold it, it was like $3.60. So that's hard to hold something that long, but it just kept going up and up and up because the dividend kept being increased. And then finally it hit overvalued, broke my heart. But hey, the rules are the rules. Sold it. 4 months later, COVID hit, market dropped out, McDonald's went to undervalued. We bought it back. It was a
nice.
beautiful thing.
As you said that, I just realized something. I don't know why originally I had hold had a negative context in my brain for some reason, but it's not. Hold is all it really means is we're still squeezing.
Yeah,
That's
yeah,
what it means. I don't know why. I got to think why I thought that, but my brain kind of went undervalued buy. You're trying to get to overvalued as fast as possible so you can exit. My brain was just trying to think of exit, but I don't want exit quick. I want to ring this bad boy for as long as I possibly can. I want to find
absolutely.
a McDonald's is what I'm looking for. That's
Yeah.
what I want.
Here,
Yeah.
here's my perfect scenario.
Yeah.
It's never going to happen, but this is kind of like my lotto dream. 25 to 30 stocks, well diversified, all bought in the undervalued area, and they raised their dividend so much, so consistently, they never get to overvalue, and I never have to sell.
Gosh darn it.
That's my wildest dream.
That changed something in me. I think I was okay, I think I know why. Okay, after I had kids, I became more risk adverse. It changed. I was way riskier with my investments. I was willing to take more chances. I was doing a lot of stuff that gave me great gains that I don't think I'd ever do now. And I think that's why I was selling so quick. I think that's why my brain is like, if I enter an undervalued position, I kind of want to get out of it as fast as possible, collect and get out as fast as possible. But using this methodology, understanding that no, I want it to stay in hold. I want those dividends to keep increasing
Yeah,
in large amounts, and I want to keep because I don't technically want to sell. I want this to be I want this to. I'm just gonna keep using McDonald's in my brain. I want to turn everything into a McDonald's if possible.
yeah,
Um, that changes it for me. That actually changes even when before we got on the call today, I was looking through the list and I was just picking stocks that had crashed the most, being like, great, because they have the highest propensity for a quick
yeah,
turnaround. Like if they
yeah,
drop by 200%, it'll bounce back. Like it's gonna recorrect
yeah,
at a stable level, which means you'll get the most immediate gains, but it may not stay in hold for the longest period of time. So for long term gains, they might not actually be the best bet. Rather than one of these other ones that didn't have the harder crash, like the ones you named, I was looking at them like Merck and Company, MT&T, Clorox, like UFPI, they don't have the 200% stock price crash that I was looking at, right? They're
yeah,
like 30, they have
yeah.
30% or 20%, which is still great, by the way. But
Oh, yeah. You're buying, like I said, you're buying at a discount, which in every value guy's heart of hearts, it's like you want to give me $1 worth of assets for 70 cents? Okay, I'll
yeah,
play. I'm good. Yeah, Brown Foreman. I think you and I talked about Brown Foreman.
yeah,
Um,
they're on my list.
yeah, that's an undervalued stock. Their cash flow internals are fine. I think they're a victim of um, there was worry. I think there was tariff issues.
That's
That
what I like though. Yeah.
yeah, that Europe was going to punish us, but we've since signed a tariff deal with Europe, and so that's gone away. And then there's might be this cultural thing where someone was telling me the other day. Well, people aren't buying as much hard liquor. And Brown-Forman is a distiller. I mean, they make whiskey and, and I'm like, yeah, that's not going to last forever because, it's like tobacco. I mean, is
Yeah.
tobacco a horrible, dirty business? Yeah, it is. Not a lot's changed with human nature since the Garden of Eden. People like stimulants.
Yeah.
Nicotine is a stimulant. They like to get happy and they like to drink. So, what we used to call the sin stocks, like booze and tobacco,
Yeah.
uh, they get a new crop of customers every year. So, you know, I'm not too worried about Brown Forman. I think it's a steal, actually. Symbol is BF.B. Yeah.
Do you have a style within a style? This is I won't even call this a style. This is a proven way of investing. This is a data-driven way of investing. I'll say that. Coming from an advertising background, I work up data analytics. This is a data-driven method of investing. But do you have a personal preference within here? Because like you said there is 90 on undervalued or something. We can't all invest in anything. Are there criterias that are to your personality you do to help filter through? Or is there an extra thing you're looking for? Like I told you beforehand, I was looking at who crashed the hardest, and that's why I picked out 5 from my 90 because that stuck out to my investing style traditionally. Do you have something that you do like that?
So, gosh, that's a great question. No one's ever asked me that. Do I have a style? I just, I want to beat Mr. Market. I
That's what I'm
want to,
trying to do too.
I want to beat him I want to beat him with my game. I'm not going to beat him in his game, but I want to
Uh,
try to beat him at my game. And so, what all I want to do is I want to find companies that are being ignored for the wrong reason. They offer great value. Their cash flow internals more than support, what's happening with the company. And so, my predecessor, my mentor, Geraldine Weiss, who actually started the newsletter back in 1966, um, she had a nickname. People used to call her the diva of dividends, or the dividend detective, and that's kind of, I think, what we are. Is we're sort of detectives. Um, we observe other investors' behavior. That's how we figure out what these repetitive high and low yields are. Um, and so I guess I'm looking, Gary. I'm looking where other people won't, because I'm trying to find gem. I'm trying to find the next McDonald's. Okay,
yeah.
people. Yeah, this is like, oh, McDonald's. Come on, you know, seriously. TJ Maxx. TJ Maxx is a great example. Uh, the department store.
Yep.
That company, I bet you I've held it almost as long as McDonald's. Phenomenal management. They're just so smart. They're just kicking everybody's tail in their sector. All the other retailers are scared to death of them. They just have a phenomenal model. But that stock has gone up and split and gone up and split and gone up and split, and just they raise their dividend over and over and over. But when I first started recommending TJ Maxx, people were like, TJ, what? TJ Maxx? Really? Are you serious? Who shops at TJ Maxx? A lot of freaking people, trust me, they do. I mean,
Yeah.
they should erect a statue just for what my wife spends there. But
Yeah.
anyway,
Yeah.
yeah. So I would say don't have a bias
Yeah.
if you've got preconceived notions. And look, but I understand if you've got. Look, I had somebody in my family that died of lung cancer. I'm not buying back. Got it.
Yeah.
Totally understand it. I've had somebody in my family that died of cirrhosis of the liver. I'm not buying any alcohol. Got it. Understand it. I don't like guns. I'm not going to buy an ammunition company. Okay. There's things like that, which I get it, but other than that, I just think try to have as open a mind as possible, and Mr. Market will give you opportunities. You just have to be open and look for it. That's what I'm trying to say.
One thing I do a lot, and I use it as part of my criteria, is so I got a company that's cash flow positive. Basically all the financials look good. This company's like, oh, this is a healthy company. It looks good. And then I feel like it's undervalued, but then I do some research and I feel like it falls into sort of a Brown Foreman area where it's undervalued because of negative sentiment for some reason, or like it's news related. I guess I'll say it's a
Mhm.
temporary weird thing that has nothing to do with the company itself, and it's not even it's a
Exactly.
figment of everyone's imagination. And then that's when I go, this is now getting near the end of where I think I'm about to purchase something, because and then I that's when I also see historically for myself those crazy returns, because I go, this company, once people realize what were we freaking out about, corrects to back its actual market price, and then they get on back to what they were doing before. They just continue on, but I bought at such a low price because of this weird scenario. I use that as my last great filter. That is my filter. Once it hits that filter, then I go, now it's a buy. And
Look,
then,
when you find something and you look under the hood, if there's nothing fundamentally wrong with the company,
yeah,
their earnings are there, the profits there, the market is not pricing them correctly, and all it is a knee-jerk emotional reaction. Yeah, that's a gift. That's, thank you. Give it to
that's
me.
how I
Yeah.
that's how I view it. And I kind of I now I it's obviously my investing is a little bit slower now because I wait for a criteria like that to sort of show up on top of everything. But I feel like that gives me a little bit more security. Also, I had a question because I told you I'm getting a little bit more conservative in my investment. I used to do lump sums. Like, I believe in this. Let's see, I found a gift. I would put if I had $100,000, I'd put 50,000 into it. But now, and this is after we spoke the first, yeah, but it worked. Like, I did that for I did some crazy things, like when Meta was like $80 or something. Like, I've done some crazy stuff where it worked out great, but I don't do that anymore. Like I said, the kid factor, because I didn't worry me. I'm like, I can make the money back, but now I have wife and kids. I'm like, I got to invest structured, more disciplined, even if it means
Yeah.
less gains immediately or whatever. It reduces risk. And I just want to have a chart like this now rather than immediate lifts, because I got people who rely on me. Waiting. So waiting is my next big thing. So do you do like we're talking about like 25, 50 companies, and it was after our first talk, me and Kelly, we spoke a few months back, that you kind of changed how I view this now. I'm like, this guy's holding 25, and you've been doing it for a while, so like the proof is in the pudding. I was like, 25, 50 stocks. I'm like, that's interesting. I never thought of having that large of it, which means I got to change my weighting. I don't have enough capital to do 50K on everybody. And so I've sort of weighted in, like, I'll start with, for me, comfortable number to figure out is like $10,000 into something. And then I start there. And then and I did that with United Health, and I'm okay with it. I don't have stress. I don't have any knots in my stomach. Whatever, it feels good. And I was going to and if I have, let's say, 10 picks, 20 stocks, they're going to be equally weighted with 10K, 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 10K. Do you do equal weighting? And it could be 1K, 1K could be 100, whatever your budget is, but it's equally split. Do you do that, or do you, dependent on where you think this is? I was like, unicorn to a gift to or do you even deal with not sure? Is it all always the same feeling, deserve the same weighting no matter what? Or do you ever go
Yeah.
outside of that?
Yeah. So, I have a fiduciary responsibility because, I'm a portfolio manager and I manage other people's money. So, um, if someone gives me X dollars, all right, I divide that number by 25 or 30 and see, okay, then that's my allocation per stock. All right. Um, and that's really how I approach it. And you can argue, are there 9 sectors, are there 10 sectors, whatever.
Mm-hmm.
Um, and then, I just want to get to that 25 to 30 stocks as equally diversified as possible. And yeah, it'll be an equal weighting. Um, if I took a shot here or took a shot there, could I juice my returns? Yeah, probably. Um, but I try to stay within the discipline. Um, and because once the camel gets his nose under the tent, and you kind of, oh, I should speak about myself because back in my younger days, there was things I did that were nuts. I would never do now. But once you kind of deviate from your discipline and you get away with it, it's like the worst thing in the world that can happen because then
Yeah.
you go, oh yeah, yeah, all right, okay, all right. So yeah, I've got my rules, but if something, then maybe I can cheat and do a little, yeah. That ends up ugly sometimes. So yeah, I just stay within the discipline and that's it.
So you do that even in your personal life, obviously with clients, but in
Oh
your
yeah,
personal life for the most part.
oh yeah, yeah. I
That's sort of, yeah, go ahead.
I can't deviate because I have to be um, I have to be honest with my subscribers and my clients. Um, if I don't eat my own cooking,
Yeah.
that's like, yeah, yeah. No, I can't. That's it's probably not unethical, but it just doesn't seem right to me. I gotta, you know, uh, I gotta walk the walk and not just talk the talk.
I feel like there's three steps in most investors' journeys when they get into investing, and I'll kind of outline it. It goes, you know nothing about investing,
Hmm.
and your bank calls you and says you should buy a mutual fund.
Hmm.
That's what happens. Step one, you get into a mutual fund, and you're like, wait a second, I'm giving this person 2% to do a mutual fund and yada, yada, yada. And then you realize there's something called an ETF, an exchange
Ah,
traded fund. And you're like, oh, I can buy that. And then that's better than a mutual fund. It's the exact same, but you're not paying the same management fees. You're just buying a VOO or VFB exposure to S&P 500 and your dollar cost averaging, right? So
mhm.
you're not capturing undervalued stocks when they're undervalued or over. It's just like a whatever. Then there's a point where you get to wait a second. ETFs are good to an extent if you're completely hands off. You don't want to think about this. You don't. It's
Right.
just like if you just want to like forget about it and even forget you own investments and just walk away and check back in 30 years. But if you want to have more control and you want to get really squeeze out everything out of your portfolio, there's something called value investing. Is this value investing or dividend value investing? What would I call this? Just value investing?
Yeah, we're just dividend-centric value investors, you know.
Yeah. So
And
just
I think you're onto something. My if my guess is that most people's first exposure is HR calls you and says, "We've got a
uh,
we've got a company 401k plan."
yeah.
Okay, what do I put the money in? Well, we're not investment advisors, but here's a list of funds and ETFs, and company stock. And a lot of people go, let's just divvy it up and then and they don't think about it,
Yep.
especially in a bull market because they get a statement and they go, wow, that worked out really great. I'm just going to keep doing that. And then you have a bear market and they get their statement and they go, what the hell? What happened? Well, you know, uh, yeah, the market is what happened.
Well, yeah, and I feel like with my content on the channel, I'm taking people on a journey here, right? I'm getting a lot of people who came from mutual funds who are like ETFs, and I told them what ETFs are. But I've been slowly over the last few months trying to explain to them value investing. This is how I made my money was through value investing. It was
Yeah.
I do have ETFs. I'm a kind of ETF investor. I have about 30% of my portfolio just in ETFs, just because I did start there. I have that there. Kind of like having it, whatever. It's fine. Yeah, I like it's nice. It's nice for me. I'm not bashing ETFs, but I value investing is where I do most of my work. And I feel like this is, the last level. When you're evolving as an investor, this is where you end, and this is where you could spend a lot of your investing career, your whatever, really getting
Yeah.
good at this part of it, because this is what's going to do it. Um, so like, so like you said, is that the journey? Is there a level beyond this that I'm seeing? Because now this is data heavy. I'm leveraging you guys IQ trends to make the best investing decisions. And there's a point that people don't understand, I guess, with ETFs. And like I said, I'm not bashing ETFs. I love them. I own 30% of my portfolio is that. But it's when you're buying an ETF, you're often buying stocks that are highly overvalued
Oh yeah,
within
absolutely.
that bucket. And now what I do is, and I have a different way of doing ETFs. I only buy my ETFs during, like, I really wait like years between it, like during market crash. I only bought more VFV in April when it crashed,
If you're
and
gonna,
then
yeah, if you're
yeah,
gonna do that, that's the way.
they all crashed. Yeah,
Yeah, if you're at the end of a really nasty correction
yeah.
or the end of a bear market, if that's your thing, you want to, because you're basically buying an index or an ETF that's really focused on like one sector of the economy. So yeah, if you're gonna do it, that's the time. And then if you're gonna use that as the vehicle, that's the time to do it. It's
Uh, And
yeah.
another thing, and tell me how accurate I am about this. So with value investing, I feel like, let's say, okay, we're use IQ trends. It's going to take me a while to build a portfolio I'm comfortable with here,
Mm,
leveraging you guys. But I'm being honest, guys. I'm not just sucking up to Kelley here. You don't understand. It opened my eyes a lot after our first conversation. I was like, oh my gosh, I actually wish I had you as a resource for a while because I had a lot of stress trying to do this by myself. But I realized, I'm like, okay, great. Reference point. Now I have IQ trends. I'm building out a portfolio of stocks, 25 probably, maybe less. I probably have like 20, but it's going to take me a while to build that up.
yep.
And now after today, just us talking and me relating hold to squeezing, I'm
Yeah.
now thinking I'm building 20 that I want to squeeze for long. I'm not actually not looking
Yeah.
for the initial lift anymore because that initial was coming out of fear. I was looking for that lift
Yeah.
out of fear and sell. And now I realize, just talking to you, wait a second, that's what's happening. So thank you, therapy. We worked through something for me. So, but now I'm squeezing, but I feel like, and I say I get to 20 dialed in, I got some stuff. Other than looking monthly, reading a newsletter, seeing where everybody's at, my maintenance on it actually won't be too hard, other than when I get more capital I want to allocate. And I go, okay, let's go back into research phase. But really, I'm just kind of keep my, so it's actually doesn't, once the initial setup is done, which I feel could be like a lot of like getting everything set up, then you're kind of in maintenance mode of like checking it quarterly or checking, or for me, just reading the newsletter. I mean, like, hey, what'd you guys send me this? And you'd be like, looks good, looks
Yeah.
good, looks good.
So yeah, you got to be patient because unless it's at the end of a bear market or a really brutal correction, Mr. Market's just not going to give you 25 to 30 diversified undervalued stocks that you want to ride and die with. I mean,
Mhm.
so it it might take you 6 months. It might take you 9 months.
Yeah,
It's going to take you as long as it takes.
yeah.
And that's the hard part is, I tell people all the time, I learned a long time ago to uh, say no till my tongue bleeds. I, you got to wait because I mean, this is your fortress. This is what you're going to ride into battle with. But once it's put together, yeah, you hit the nail on the head. It's just, okay, how far to overvalue? Okay, we're cruising, da 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 da. And then, like I said, I don't really start paying attention to a position until it gets to within 10% of overvalue. Um, and that's when I kind of start locking in, and it's like, okay, this is starting to get in the kill zone, and what's in my undervalued list if this thing gets to there and I sell it, um, what can I replace it with? And if there's nothing to replace it with, you just got to be comfortable. And like me, I go into like T-bills, short-term treasuries, you know.
I have a question. This is for you, not how you manage other people's portfolio, but for you personally. When you get into retirement, how are you going to what's your portfolio going to look like in retirement? Are you going to start selling things off to live off of, do that 4% rule or whatever people use? And the reason why I'm asking is my audience is skewed like this. We have a lot of ETF investors, right? Newer investors. Also have a ton of people who do covered call investing as well on my channel.
Yeah.
A lot. A lot of them are retired. A lot of them are converted over $500,000 portfolios, $1 million portfolios. They're 55, 65, whatever, and they're living off of that. That's their strategy. How do you feel about that in retirement? I'm not talking about younger investors who are doing it. I still tell my younger investors, can you just do value investing or even like an ETF? Stay away. That's my personal preference. But for retirement, how are you going to generate income off of these picks? And what do you feel about covered call strategies in retirement specifically?
Okay, so options are a tool. It's like any other tool in the toolbox. If you use it correctly, it does the job it was designed to do. Okay. If you don't know what you're doing, you're going to get your hands blown off. That's options are brutal. I can count on one hand friends, peers of mine who are just, it's a God-given gift, man, with options. They just, I don't, God didn't give me that gift, but I admire people that have it. But, and I have subscribers who do manage other people's money that do nothing but covered call writing. And so they tell me how they do it, which is, just don't be a pig. Um,
Yeah.
don't write a premium that's too close to the strike price because, yeah, you see this nice big fat premium and you go, oh, yeah. And then you get your stock called away from you.
Then you're gonna get calls. Yeah.
So yeah, just, I don't have a problem with cover call writing. Um, just, know what you're doing. Don't be a pig and, use it the way it was designed. Look, in terms of me, um, I'm just going to continue to do what I do. I don't do bonds other than like short-term treasuries. That's a cash holding, in
Yeah.
between.
Yeah.
Um, and I have buddies that are in the bond business, and they all tell me, um, "I tell you should have been a bond guy." And I say, "Well, what are you talking about?" They say, "You
Mm,
think like a bond guy." And I said, "What do you mean?" You want to know how you're going to get paid. That's all we want to know as bond guys. How are we going to get paid? That's okay. But no, I don't do bonds. I don't do funds. I don't do ETFs. I just do stocks. And so this is where you kind of got to have some discipline and some self-honesty. I tell my clients, look, make a budget, be honest. Okay. When you're doing your budget, don't say, I'm not going to spend money on this. I'm not going to spend money on that
hmm.
because you are. Okay. Let's be realistic. Kind of get what your budget is for the year. And then I'm a big proponent of taking that amount and putting it in a money market and drawing it down and leaving the rest of your portfolio to work.
Yeah.
And then every 12 months, it's an exercise of, okay, here's my budget. I'm going to need this much. Okay. Because then the corpus or the majority of your portfolio is working. All right. And because trying to do that monthly withdrawal and this and that, it's to me, it's a distraction. Uh, if you're wired like that, then yeah, knock yourself out. But I just want to have an idea what I'm going to spend for the year, put it aside, and then I don't have to worry about it for a year. You know?
With those covered calls I was mentioning, the people who watch on my channel, they don't actually write covered calls themselves. What they're doing is they're buying the new ETFs that come out, covered call ETFs. So they have the funds writing calls on for them, and a lot of them are
Mm.
leveraged. I'm in Canada, so there's like 25% leverage. They write covered calls on 50% of the portfolio. So I don't think they use leverage really in the States, but they use it here in Canada. And there's 25 to 35% leverage. 50% of the portfolio they're writing calls on, and then the yields will range between, this is like low point 12%, higher point, I think some of them are like 30
Wow.
something percent, 30 something percent on them. And nav erosion varies, right? Higher yield, more nav erosion, but you know how that works. So,
Yeah.
and
Yeah.
yeah, so that's just sort of, it's such a hot topic right now in the investing world. Like it'd be interesting to hear. Like, I just wanted to hear your thoughts on it. I feel like
Well,
if you, yeah.
okay. So I'm not a bond guy, but I have a hell of a lot of respect for the yield curve.
Hmm.
And so I know what the yield curve is on the, you know, low risk or risk free, part of the market. Um, if you start getting yields that are like significantly above uh where the yield curve is, there's you know there's a couple of things that are happening there. More than likely, you're taking a lot of risk. Um,
There's a ton of return of capital that's happening,
oh hell
and
yeah, yeah.
how growth works with these is they reinvest. So they when a lot of the cover call, I have a ton of cover calls. I make so much content on it. For me, it's more of a case study because I have a YouTube channel. So I'm like, if I'm going to talk about this, here's my portfolio, and I have allocation, and I talk about what's happening there. But I'm not a cover call guy. I don't understand it enough to really be like, this is I'm a value investing guy. That's kind of my thing with some ETF. But I talk about it on YouTube, so I live and die by the sword. I'll show you what I'm doing, and we can see the mistakes. But what's happening is the way I only see it working is you have to reinvest a large portion in order for it not to erode from NAV erosion, which means you're taking it and you're just buying more shares of that ETF to keep it growing. Especially if you're a young investor, and that's where you get growth, is you're constantly buying back more shares. And then it's just like, well, you're not technically living off the income because you're constantly buying back more shares. And when I did the numbers, it's, you're always going to have to keep reinvesting like 30% back in, even when you're living off the
Mm,
income. And depending on which account you hold into, if you're in a tax sheltered account or a non-registered account, if you're non-reg, you got to start holding back even more money, right? Because you got to pay taxes and all this stuff. So it becomes a little bit more complicated than just free money. Well, when I
yeah,
looked at it, it's like,
and
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 it
and
actually
the
becomes kind of crazy to manage as well.
yeah, in the States we call it UBTI, and
Yeah.
unrelated business taxable income.
Yeah.
Um, but yeah, I mean, go look at any mortgage REIT or mortgage-based fund that's got any time history, and look at the NAV on it. I guarantee you, boom, like that, because yeah, that's so. I mean, if your income, yeah, that's too risky for my. I'm not going to fool around with that. Yeah.
Do you think the reason why value investing, and because I'll make a value investing topic on my channel, and I'll notice it'll get 1/10 of the clicks of me going, here's a $3,000 a month cover call portfolio, is because value investing, this style of investing, directly rewards the patient and disciplined. The more patient you are, the more thorough you are, and all this stuff. It's just like that willingness to take the attention, invest properly, understand the squeezing mentality of it, and understand long term. It requires even more patience than an ETF, because an ETF is like so buy and hold, but it's still a little bit like buy it, forget about it. Here, there's a little bit of research involved, and more really picking, understand. You have to still
Yeah.
understand what you have to understand you're
Yeah.
holding. You think that's why it's less sexy? The internet doesn't respond to that kind of investing style. It's not sexy enough.
I think this partially goes back to those different stages of investing, and I think most inexperienced investors, they have a lot of near time bias,
Yeah,
which is, oh, here's a name I've heard.
yeah,
It's going up, uh, so it's probably still going to go up. And so, yeah, I'm going to buy that. All right. And if you're catching a bull market in the right place, yeah, you can get a ride. And then it's reinforcing. Oh, this was good. It's a reinforcing principle. Um, and it's immediate gratification. Okay.
yeah. That's
Um,
what it is.
yeah, but what I try to explain to my subscribers is, and my clients, investing is a business. It should be treated as a business. This is not a lotto ticket. This is not a casino. This is, yeah, put it on Black 19. Okay. Um, Investing is a business. If you were going to go out on Main Street and you were going to either start a business or you were going to buy an existing business, which is basically when you buy stock, you're buying into an existing operating company. You become a part owner. You want to know that that company has a history of increasing revenues, because the sole purpose of investing is a return on investment. That's the only logical, rational reason to put your hard-earned money at risk, is to get a return on investment. So value investing, I think, necessarily encompasses that it's a business kind of a mindset. You know, we're not in Vegas, we're not playing, we're not gambling. I mean, Nvidia is priced the way it's priced right now. Their revenue is going to have to grow at greater than the GDP of some small countries. I'm serious. I
Yeah.
can show you the math. For 100 years
Yeah.
to justify the price today. That is insane. That's just
Yeah.
insanity. Now, is it a great company? No argument for me. Are they doing great things? Absolutely. Is it a good investment as a business? You're out of your mind.
Yeah.
You know, it's crazy. Yeah.
I have a couple things here. So Nvidia is interesting. So I never bought it because I felt like it was overvalued. April market crash happened, and I bought a bunch of stocks I would never hold because I thought they were overvalued. One was Nvidia, one was Tesla. And the reason was I bought them with the intention to immediately sell because I went, oh, I'll just quickly make 40%. I
Mhm.
literally, it was the closest I've ever got to day trading. It was when I went, great, it crashed. They dropped by legitimately like something crazy, like especially Tesla, that just tanked. And then they immediately corrected back and now they've exceeded. And then I just sold them off. I went, that was really easy money. But that's the shortest term, and but that's such a weird scenario. I was like, this is like the weirdest scenario I've ever been. It was like tariffs crazy, and then that V curve came back so fast and so
Yeah.
strong because it was pure nonsense, and it was for me obviously pure nonsense. I was like, oh okay, I guess I'll just. Do I want to make a quick X amount of money? Sure, do, and I was in and out of positions within 2 months. And I was like, okay, that was weird. And I'm like, I'm never gonna buy back in because I just would never hold these things, right? That was like the only use case, but like I can never recommend that. When is that weird scenario going to happen again? That was just such an odd. Like I would need a volatile president saying a bunch of stuff, and I need all these circumstances to happen to
Sure.
create an atmosphere
Sure.
where that would happen. So I was like, so I wouldn't even say that's part of my investing style because that's just so odd. I want to hear a little bit about this. Okay, so because we talked about the journey of like people go from like mutual funds to ETFs to value investing, and the reason why I got excited was it's not sexy for other people because you said something thing. It's like they're not there in their investing journey yet. They don't know that this is what they should get excited about is these resources. My thing with investing was I always talk about I'm like I wish I had more education on investing when I was younger. No one talked to me about it in school. It was always voodoo. It was always like, oh my God, and that's where people go to gamble. We all had stories of that uncle who invested and lost all their money in the stock market. So it was always gambling associated. Then I got older. I got into advertising. I got clients who were publicly traded companies, which got me to ETFs. So I jumped into ETFs. That's why my portfolio is big in ETFs because I started there. But then I realized I'm in data analytics. I actually should start picking like winners within the actual like undervalued stocks, and I started value investing, and that's when I really got supercharged. But it was luck drove me here. Luck, 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 luck. I could have lived my entire life and not invested a dollar if I didn't start marketing and didn't happen to get clients for publicly traded companies. I would have never have known. Nobody in my personal life knows anything about investing, so nobody I knew was going to tell me. My YouTube feed wasn't telling me anything, so it was just I would have been ignorant to it, and I would have been like every other Indian guy only buying real estate, right? And that would have been my investment. Right? That's it,
Well,
right?
that's funny, dude. That's
Yeah,
funny.
we're born into that. So that's what I was born and bred into always doing, which is great. I'm happy. But that's that. I kind of want you to walk me through because I think some people relate to this. Who were you before you got into investing? What gave you the investing bug? I've met some younger people, their parents taught them how to invest. They got lucky. These younger guys coming up, they have dads who kind of figured out the hard way like me and then taught their kids. They got like, I'll do that with my kids. But how did you find out about investing? I kind of want you to talk about how you got into the position you're in right now, because I think that's a really interesting story with, I think Geraldine Weiss. That's her name?
Yeah.
That's it.
Mhm.
I want to hear about that because people need to understand this and both the books and take me on that journey of where you came from, of not knowing anything about investing to where you are now.
So, yeah, um, my first teacher and mentor was my maternal grandfather, who I pretty much grew up with. My grandfather was a Depression era guy. Um, Large family, like 9 siblings, uh, from the farm life in Eastern Kentucky. Uh, him and my great uncles started uh, out as painting contractors, and they would paint the big electrical towers that would run down the middle of a freeway back in the South and in the East. So very dangerous work, but they got paid a lot because it was dangerous work. And then they started a hardware glass and paint store. You know, uh, my grandfather was not formally educated because he grew up on a farm. The family had to work on the farm, uh, and so he started making some money though. But and even though he wasn't formally educated, he was smart enough to know I got to start doing something with this. And as he used to tell me, he'd say, "Son, I went to the University of Hard Knocks." Um, he said, "I learned by making mistakes." And so eventually my grandfather figured out that uh, blue chip dividend paying companies were a better option, than anything else. Uh, and so from the time I was like 10, 11,
Wow.
12 years old, yeah, I mean, he would take me on a job site and whatnot. Um, but he started talking to me, and he didn't have the language, he didn't have the vocabulary. I figured it out kind of later on, but he really learned a value style because he got his hands blown off, because he didn't know what he was doing. But he finally figured it out. And so then I got to school, and I read this book by this guy named Benjamin Graham, and went, wow, okay. So now I kind of had a vocabulary to understand a lot of the stuff that my grandfather imparted to me. And then there was a buddy of mine that said, hey, man, if you like Benjamin Graham, you've got to read Charles Dow. And I said, what do you mean, like Dow is in Dow Jones? He goes, yeah. And I said, well, that's just he's the guy created the index and stuff. And he goes, yeah, yeah. He said this guy was a value investor. He said most people don't recognize it. He said the whole catalyst behind him developing the Dow was he was searching for a mechanism to allow him to know when the broad market offered value. So that's what he was in search of.
Okay. Yeah.
And he wrote like 16, 17 different vignettes about value investing. Anyway, so I started reading Dow, and I was like, wow, okay, cool. So now I kind of had like Charles Dow, and I had Benjamin Grant. So in 1985, I got hired at a small boutique brokerage firm in La Jolla, which is part of San Diego. And the guy that hired me, he asked me one day, he goes, "What's your investment philosophy?" And I said, "Well, I'm comfortable with blue chip dividend paying stocks." And he kind of went, "Uh-huh." And he handed me a copy of Investment Quality Trends. Uh, and he said, "You need to read this." He said, "I think you and the editor are cut from the same cloth." And so I opened it up and started reading it, and then it was like, oh yeah, okay, I get this. Here's the funny thing. Her office was 3 blocks away from our brokerage firm.
That's the universe, man, coming together.
And
Lucky.
I never had the guts to walk
Wow.
over and just say hi, you know.
Wow.
But then her book came out in 1987, the original Dividends Don't Lie, and I've got it here somewhere. I'll have to show you sometime. I mean, it's yellow, it's dog-eared, it's yellow marker. I mean, I've just abused the hell out of it, but there's parts of it that I literally memorized. And she, was kind of from the same era as my grandfather. Um, and her family was value investors. And so she's the one who really developed the dividend yield theory, which is high quality stocks trade between two repetitive dividend yield areas. And that was like, as she used to say, we have a fundamental approach to technical analysis, which the first time I heard that, it just blew my mind. And I went, what? Wait a minute. There's fundamental analysis and there's technical analysis, and the two don't meet. And she said, yeah, they do. And let me show you how. And it was like, oh my God. Anyway, back in 2000, um, my younger sister came to me and said, hey, do you know who Geraldine Weiss is? And I kind of started laughing and it was like, yeah, I know who Geraldine Weiss is. What's curious to me is how the hell did you know who Geraldine
You know
Weiss
what it is. Yeah,
is?
exactly. Yeah.
Because my sister, God love her, she wouldn't know a stock certificate if it walked in and smacked her in the head. And she said, well, her son, who's an attorney, is a client of mine. My sister was a physical therapist. I said, oh, that's wild. That's crazy, man. What a small world. And then it's like a couple of weeks later, she goes, hey, I was talking to my client. And he asked if you'd like to meet his mom. I said, "Oh my God, yeah, okay." I mean, I turned in like to a fanboy all of a sudden, and it's like, yeah, I would love to. So they set it up, and it was supposed to be one of those like 30-minute meet and greet kind of things and so I went to her office in La Jolla and sat down, and we just started talking, and it was like 2.5 hours later.
Wow.
I mean, her 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 idol was Benjamin Graham and Charles Dow. And I'm like, oh my God, me too. And so we just started talking investment theory and approach and all of this stuff. And it was like we were like two peas in a pod. And she sort of reached over like at one point and patted me on the knee and said, honey, you get it. I think you should run it. And I went, what? Are you, no, I'm not a writer. I'm just a stock picker. I've got my investment management business, and yeah, I mean I don't know how to write. I'm not a writer or any of that stuff. And she goes, no. She goes, you get it. Don't worry about the writing. You'll find your voice. You'll figure it out, and blah blah quack. And I said, I gotta go home and talk to my wife. And I did. I went home, and she looked at me and she goes, do you know what you're doing? And I said, yeah. You know that I know what I'm doing. Is this like what you've been doing for the last 25, 30 years? Yeah. Why are you talking to me? Call her and go take care of this, And yeah, so that's how I ended up taking over investment quality trends.
That's the most organic transition into everything where the books into her, it's just like generationally just ended up where you are now. Um, with that, you said a couple interesting things. You said Geraldine is Depression era, your grandfather Depression era. They're
Yeah.
both into like value stocks.
Yeah.
They're into, blue chip dividend stocks. But that's a very much a you came from hard times. You don't want bullshit. I want
Hmm.
something real, something tangible. I feel like when I look at the stock market thing, this makes me apprehensive of buying. Is why I don't buy Nvidia. I go like these are inflated prices, a lot of speculation, a lot of. Sometimes I feel like people investing into imaginary outcomes. I was like, I don't even know how they deliver on these. Like they're so I don't know. It just is so much, and the news cycle and the conversations around stocks. I'm like, all of this sometimes feels like a house of cards, not based on any fundamentals, and is extremely dangerous. Do you think it's because the last 30 years, or the people in the markets now, did not experience what it's like to live through a depression era, did not experience what it's like to lose everything and
Mm,
understand, oh, no, no, no. You need to like get back to the boring thing because when shit hits the fan, that's what you want to be investing because they'll outlast the hard times. And that's long term investing where we've forgotten that now.
yeah, yeah. Well, my Geraldine and my grandfather, they lived through the crash,
The
the
crash, yeah,
crash,
that's what I was getting at. Yeah, the
the
big
the
one.
crash. Yeah.
Yeah, yeah.
Um, Geraldine started the newsletter in 1966, which was the beginning of the bear market that didn't end until December of 74, where the S&P lost 54% of its value. Um, so my subscribers, the demographic of my subscribers are, I have subscribers that tell me, Kelly, I don't like to buy green bananas uh, because I might not get to eat them. And then I, I've got some Gen Zers who are like at college and they're getting a degree in finance or business or whatever, and they stumble across. So they're really different than the seasoned, the seasoned folks, they've been through it. Um, they've seen a major market crash. They know what it's like. In 1987, I was at the old Dean Witter, which is now part of Morgan Stanley. I remember October 19th, 1987, like it's the back of my hand. I was in the office early before the market opened, and in California, where I live, the market opens at 6:30. So I was in early because I had something to do. And I remember I flipped on my Bloomberg machine and I looked at it and I went, "What the hell?" Because I saw all this red from the options
Yeah,
market and stuff, and I said, "Geez, what the hell is going on here?"
yeah,
And
yeah,
then
yeah.
and then the market opened and it just vomited. And there was guys in my office that were my age now. I'm 66, and there was guys in the office then, and I saw guys with like these pale faces, just absolutely scared to death, and it hit. I mean, it was a visceral thing, and but then it was like 11:30 California time, I think, and Alan Greenspan came on and said the Federal Reserve stands ready to provide all the liquidity that the banks and the brokerage firms need. And in my head, that clicked, and I went, "Oh well, shit, that's it.
Yeah.
This is wow, okay." And I started buying. I mean, God, I was young. Today, I probably would have waited a little bit, but I started putting in tickets and I started buying stuff for clients, and yeah, and that was basically it. But and then there was the tech wreck in 2000, and then the mortgage back thing in 2008. So to answer your question, I didn't mean to take you over the hills and through the woods, but people don't know market history, and they don't want to take the time to learn market history. And for a lot of them, it's oh well, that was then, and we've
Yeah.
evolved, and this is now kind of a thing. We've got all these technological advancements, the blah 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 blah. Look, there's a reason why I left and started my own firm in 1990. I got out of Wall Street. I didn't want to be on the sell side because I didn't, that wasn't me. I didn't believe in that. And I just wanted to run my own money. Uh, Wall Street cannot help itself. Go watch a movie called Margin Call. Go watch The Big Short.
Oh yeah.
That's real. That's
Uh,
real. That stuff happened. Um, and this is just go back in the 70s and read up on something called the Nifty 50. 50 blue chip dividend paying stocks. They were called one decision stocks. Doesn't matter what you pay for them because their earnings are going to go up forever. And yeah, go read about the Nifty. So this is just another incarnation. Wall Street can't help themselves. They're riding the tech boom just like
yeah.
they rode the Nifty 50. They rode junk bonds in the late 80s. They rode the Japanese market in the early 90s. They rode the dot-com thing from 95 to 2000. Then they rode the mortgage-backed thing. I mean, Wall Street cannot help themselves, and the public, for the most part, does not take the time to understand the history. Wall Street is not your friend.
Yeah.
They're not your friend. They're not, they are not there to help you. I see these commercials, about such and such a firm. Sit down with our financial advisors and let's make a plan. No, sit down with our financial advisors and they've got a template and they're going to plug you into these uh, bar charts and pie charts. And it's going to look very scientific to you. And you're going to go, oh, yeah, they do not give a rat's butt. Okay. So this is a business. Treat it like a business. All right. Be responsible. Take responsibility for what you do because, people who say, well, I didn't know what I was doing and I just trusted. It's like, why?
Yeah.
Why? At what point did how old are you? I mean, come on. Um, yeah, it's a business. Don't don't make dumb business decisions.
Yeah, and a lot of people see it probably as like easy money or stuff like that when they get into it as well. That's a common mistake.
It's
Um,
not a casino.
yeah, and
Yeah,
one thing you mentioned before, and I was kind of thinking about when you said it, when you applied for that job and that person asked you like what kind of investor you are, you're so quick to just say I'm a blue chip. I'm a, blue chip, dividend investor. That
yeah.
was very clear, concise. You're able to remove distractions off your investing style. I thought about that. And as you're saying, I'm like, I don't know if I can say exactly what I am right now. I'm a little bit conflicted in different methods. Obviously, my YouTube channel screws it all up for me a little bit because I'm creating content and stuff. And I think that's added to some confusion. I feel like I'm more or less a value investor in line with you, but I guess I'd say a hybrid investor, but that's still too conflicted for me. How important is it? Do you think it's good for people to at least have some level of a simple one sentence label for what they are in order to remove distractions and remove impulse buys? I mean, like, because when you have a name for yourself, you kind of have a thesis, you have a strategy, right? And I think that'll keep you kind of in line. Like, you say you don't deviate, you stay within that structure. Do you think people should try to develop something, regardless of if they want to be blue chip dividend investor? They go, even if they go like, I'm that crazy covered call person all the way, it's better to know what you are rather than be a bunch of different things and be shitty at everything, rather than, or just
It
get
it
good at one
if
thing.
if you read my book, and I'm not trying to push it, it was written in 2010, so it's 15 years old. But the first line is know who you are.
Yeah. Yeah.
It's imperative to answer your question. Do you? Yeah, you need to know who you are. You need to be really honest with yourself and say, um, these are my goals. These are my objectives. Um, and this is what I need to build in order to have the income to meet my needs in year X. So I'm going to need to put this amount away every year and earn this rate of return on it. well, in order to earn that rate of return, I'm going to need to do this. Um, yeah, yeah. And I think that's, well, I know it's a mistake a lot of inexperienced investors make is that they don't, yeah. Um, I said it earlier that the purpose of investing is to earn a return on investment. Uh, and it was only until someone asked me once, why is that important? And so the knee-jerk answer for everybody is, well, that's to make money. Yeah, well,
Hmm.
money for what? Money for whom and money for when? And it was like, what?
Yeah.
And then it crystallized and it was like, oh, yeah, you got to have a plan. And I'm not talking about a financial plan with your insurance broker. I'm talking about, and I talked about budgets earlier, and I'm not, look, uh, mine's not the most detailed. I have a general idea. Um, but it's a useful exercise. Know your budget. This is what I need to, hey, you might need to pay for college. You might need to pay for elder care. You might want to buy a vacation home. I mean, I don't know. We all have needs, and a need is anything that makes you feel safe and secure. And that's why we invest is to get a return on investment to meet our needs. Okay. You have to know what your needs are. Um, the basic ones are food, clothing, shelter, transportation, education, medication, recreation, inebriation, whatever. I mean, those are your basic needs. But then there's specialized ones. Like I said, like you might need elder care. If not necessarily for someone in your family, but maybe for yourself later. Uh, you got kid. I've got 5 kids. You know, uh, they're all out of college now. Praise God, except the baby who's in his freshman year. So I've got I've got that 3 years on the horizon, and then we're all good. Then you know, um, people ask me all the time, when are you going to retire? I don't know. Isn't retirement doing what you love?
Yeah.
I kind of already doing that. I mean, what am I going to do?
Yeah.
This is what I do. I'll probably do this for a while and, you know, but I know my wife, God love her, you know, and she makes jokes, but how your wife is the one who can make the joke, but there's a little bit of a, you know,
Jesus. There's
yeah,
a lot more than a little bit with my wife. There's a
yeah.
lot. There's a lot of
Somebody's been promising to take me to Europe for
that. Yeah.
a really long time, So,
Yeah.
and yeah, but my point is, it's business. The business is to generate a return, and the purpose of the return is to meet needs. It's that's it. That's that's the um that's the Venn diagram, if you will. That's the
Yeah.
structure.
That's the framework.
Yeah, yeah. So
Well,
yeah, if you're not
there's a
doing that, you're going to do something stupid.
yeah. There's something I want to run by. This is something I've been doing lately. I just want to hear. Do you think I'm overreacting, or what I'm sort of been doing lately? Is I mentioned bought Tesla in the video, but I sold them off really fast once they just bounced back because I didn't see why they're valued so high. I want to get rid of them. And it's a large reason why I don't actually invest into my ETFs that much anymore, like VOO, is because I see the stock market like this and I just see a giant overvaluation. And history wise, I go, that's not that's not sustainable. Whatever this upwards trajectory into the infinite of everything, just like prices are getting like all-time highs and at all. I'm like something like I just don't. It, and then I brought guests on. They're like, by the way, a lot of that's inflationary. It's like the money actually moving, like actual money, like the inflation is causing it to raise.
Yeah.
It's not the actual money being moved around isn't that much more than it was like whatever how many years ago.
Yeah.
And so what I've been doing is I've been reducing my tech exposure because I feel like that has the least margin of real growth and it's the most volatile and it's evolving so quickly. I'm like, I don't even know what any of these companies are going to look like in 10 years because of AI and everything. I'm like, they're not like fundamentals to keep our society running. They're just like weird things that come out. Everything's changing so fast. So I started selling individual positions of tech exposure for individual stocks, limited buying ETFs because ETFs basically when you buy VOO, it's just like how much of percentage is just really just like Amazon, Tesla, like it's just those companies again. So I bought it on the dip because it made sense. But so I've been reducing those positions with that in mind, being like these aren't they're so unsure. The technology is moving so quick. There's so many question marks. And I've been sort of now taking all those profits and stuff. And then I'm coming back to that blue chip dividend value investing style of like what's going
Right.
to still be here in a while because I'm expecting history to repeat itself eventually and there being
Oh yeah.
some level of something happening and I
Oh
kind of want to
sure.
not be and I want to have my selection to be the ones that are like the ones not all of them obviously that will outlast whatever that major event is of some sort because you just look at the stock market. I'm like, all this doesn't look. This is not natural. And people coming in, I've talked to friends being like, I just bought XEQT like an all-in-one ETF. It's like I'm up 20% and I did nothing. I'm like, they're thinking those are normal returns. I'm like, that's not normal. I'm like,
No.
the reason why you have a 10% average yield when they go historical return is because the market never delivers actually 10%. It will give you 1% and then 25%. It's the average is the
Right. Right.
10%.
Right.
It's I'm like that average came take a 30-year average. Understand that no one ever got VFV VO is never giving you a 10% return ever. It's always giving you a horrible return or some
Yeah.
weird outsized return. And we're in this outsized territory where I'm like, all right, that's not gonna last.
Yeah.
So
The standard deviation on that, if you not to,
so I'm
yeah.
so I'm kind of pulling out things that I know are part of that upward, like the things that are that created that huge effect. I'm like, I'm gonna, and I know, and I can see it. I'm like, I'm exiting early. Like I know I could probably ride it out a bit longer, but like I said, I have kids. I'm like, I think I'm clued into something. I think I'm seeing this accurately. I'm gonna start exiting early, and I looked at some stuff some institutions are exiting early too. They're not as
Oh hell
invested
yeah.
into the
Yeah.
and
Yeah.
and I'm when you see what things, but retail investors aren't. They're excited. They're still, and I'm going okay. Well, you see, I'm like it's the institution because they're actually caring about making money. I'm like great. So I've been exiting out of this stuff, and now that's why I have more cash allocations and stuff because I'm getting out now. Because I'm thinking I'm in. This is I'm like you slowly walk back away. I'm slowly backing away, like
Yeah.
getting back to the fundamentals.
Who do you think the institutions are selling to?
Exactly. So do
To
you
the
think
retail investor? No, because in I'll let me explain it this way. If we look at the most reliable measures, the most historically reliable measures of value, the S&P 500 is at the highest valuation it's ever been in history. I'm talking about we took out 1929, we took out 2000, we took out 2008. This is the most overvalued that the S&P has been ever, ever. For the S&P to get to garden variety, middle of the road valuation. I'm not talking about drooling at the mouth. Oh my God, I'm going to steal money to put it in the market valuation. I'm just talking about the S&P would have to lose about 60% right now just to get to a garden variety middle of the road valuation.
Yeah, that's sort of when I look at it, I didn't come up with 60, but I came out with like 40 something percent. It's like trying to be like a little bit more conservative. I was like, that's scary. And I thought maybe I feel a bit better now talking. I thought maybe I was being over cautious, and I was kind of like told myself I'll take a capital hit. I'll start exiting stuff early now because I don't know when it'll happen. It'll happen, but I kind of want to not be around when it does and be worried about it every day. And I didn't know, like, when you just see something like something's gonna happen here. Like I'm getting all the pre-warning signs, and I'm just exiting it. But I'm not like I'm not investing. I'm just going back to fundamental investing. Like, all
Well,
right, cool.
and here's how a crash happens. I'll make it real super simple. It's a crash happens when reality doesn't meet expectations and the trap door opens, and then you've seen the cartoons with Wile E. Coyote when he runs past the cliff and then he looks down and then it's nothing but an air pocket and he drops. So that's that's what a crash is. It's when the reality doesn't meet expectations. And then it's a race because nobody wants to be long when they realize that they're in a it, when they're in a universe that's not making rational logical sense. And then it's a race. Who can get out first? Who can get out fastest? And it's always the institution. They're always going to beat you. Uh, when the music stops, you do not want to be the guy without a chair.
That's the best way to put it. So what I was waiting for was the music's gonna stop, and I know it's a race, and I was like, oh, I don't want to be the guy who's left standing, and and
Absolutely.
and I was like, how about I just stop playing the game before everyone even realizes it's about to be over? So I was like, I'm just
It
exiting
takes
the game.
discipline. Yeah,
Yeah,
it's hard
because I'm
because
watching other stocks go up. Google just went up a little bit more, and I started exiting Google positions. I was like, I kind of want
it's
to get out of this.
it's hard because as we started talking about at the beginning, it's emotional. Um,
Yeah.
I mean, you sell and then you see the market or the stock or the ETF or whatever it is continue to go up. And in society, we've been so conditioned. You made a mistake. You're a loser.
Uh-huh.
You left money on the table because you didn't have the cojones. No, no, that's not the right message.
Yeah, because I'll always see stuff online. They'll be like, there'll be some guy, some financial person, like, I let the winners ride. I like them what the winners ride. And I was going, I feel like in this scenario I'm in, I don't want to let this winner ride too much. And it comes back to I have to be responsible. I have to be financial. And if I feel like with my experience investing for it, I haven't invested as long as you, but historically and understanding the history of investing, understanding what I've seen, I'm seeing everything like the warning signs of like I'm gonna start exiting specific positions that I think are the most exposed to if a crash happens, they're the most exposed. I'm going to remove those highly exposed positions.
Every crash in history, every single one has had clues.
Yeah.
Okay. And overvaluation, excessive debt, too much leverage, fragile supply chain.
Yeah.
Those those are the clues. Those aren't the trigger. But what the trigger does is it exposes that vulnerability. You go back to 1973, 74, where OPEC got pissed at the West because they supported Israel in the 6 day war, 7 day war, whatever it was. And they said, okay, yesterday oil was $3 a barrel, now it's 12, and you're not going to get to import as much as you want. What?
Yeah.
I mean, that was a shock. That was a macro shock to the whole chain, I mean, and it just went downhill. But stocks were widely overvalued, had been for a long time. That was the Nifty 50. Um, there was a lot of leverage. There was two. Yeah, so the clues were all there, but it takes a trigger to expose those clues and the vulnerabilities, And so so this thing's going to go until there's a trigger. I
Yeah.
mean, I don't know if it's going to be the bond market going, you know what, you guys are boneheads, or the currency market. Those are the two biggest markets on the planet. If the bond market and the currency market decide that they're going to put their foot down and put some discipline back in, all the central banks in the world, it doesn't matter. Yeah. Yeah. The bond market, the currency markets will kick their butt. Yeah.
What impact do you think the giant influx of retail investors in 2020 had on the market? Because before 2020, like, because I come from advertising, and when, like, it was institutions were dictating what was going on. And then in 2020, all of a sudden, Robinhood, COVID, all that happens. Everyone's at home. Everyone's got this new stimulus of money. Everyone's doing it from their phone. They're making nobody during that time who were retail investors. Majority of them knew what they were doing. Stock prices were going up 3,000% in one day. And now, and I felt like that's when these weird inflated prices happened. It was like after that giant, well, it's been happening for a while, but I just feel like that was a weird thing that historically never happened with a retail investor involvement to that degree. It's still there in mass amounts. Everyone is doing it. And there's less educated investing in the stock market, which adds a level of, it's like, when you play poker, you ever like Texas Hold'em?
Yeah.
It's when you play with a
Fun.
player who's when you play with a player who's really, really good, you kind of know what you're looking at. It's actually like there's more strategy because they know what they're doing. But when you play with a player who's never done it before, it's who knows what's going to happen, because they'll go all in on a pair of twos, or they'll go on. And I feel like there's an element of that randomness where it's like, why did this stock price, like, hey, why did GameStop go up? Like, what's going on here? Is it because you have this retail influx and none of them are even doing the research? They're just chasing the dollar. Have you equated any of that into any of this? Like, because there's no historical data for this now. This is like a weird element that's involved in investing now.
Well, you got to go back to the financial crisis when TARP and the different things that Congress did to bail the banks out.
Yeah.
And we had quantitative easing, or QE. Um, all of that financial engineering created an environment that was divorced from all historical reality. I mean, in a true capitalistic system, they would have let the banks fail.
Yeah. Yeah.
Now, okay, look, we would have had a worldwide depression. Okay.
That's too big to fail. And we're back. Technical difficulty, but we're back. There
Yeah.
you go.
So we had this artificial environment of QE, and so from 2010 to like 2018, you had the artificially low interest rates, zero, ZERP, and because there was no yield available in fixed income, investors were necessarily forced to go into the equity market, which is what the Fed wanted. But so people who had never invested in stocks, they were CDs, bonds, whatever, got into the stock market because they had to, in search of dividends, or, whatever, because there was no income at all in the fixed income market. And then we had COVID. And like you said, Congress pushed $6 trillion of cash into the system. Yeah, so people were bored. They're at home. They can't go to work. They're getting paid.
Yep.
Yeah, I've got 5 kids, three of which are boys. My middle boy, who is the most likely to end up in as an investor, he said, "Hey, Dad," he goes, "I want to open a Robinhood account." And I said, "What?" He goes, "I want to open a Robinhood account." And I said, "Well, why do you want to do that?" He said, "All my friends are doing it." And he says, "You wouldn't believe, the money they're making." And I said, no, I'm not going to open a Robinhood account for you. I said, I'll open up an account at one of the major custodians and help you, you know. Um, and he goes, yeah, thanks, Dad, but he goes, your thing takes too long.
Uh-huh. Uh-huh.
And I said, okay. I said, well, when you're ready to get serious, let me know. So
Yeah.
I said, but don't
Per
go open a Robinhood account because you're going to lose all your money. And it's funny,
perfect response.
yeah, he came back to me a few months later and he goes, hey, Dad, remember those, told you about those buddies of mine? I said, yeah. And he goes, yeah, every one of them lost all their money.
Of
And
course. Of
I
course.
said, well, yeah, it's a self-fulfilling prophecy, so
But companies love that moment. Any company put out some crazy piece of news, everyone invests in. It was all a news hype. Everyone just following weird trends. It was a wild time. But that I feel like that changed though the investing market though. Just that giant influx of retail investors. A lot of them who have stuck around, hopefully become more knowledgeable. They learned how to invest and they're better at it now. But I feel like that's a new thing that's happened in the last 5 years.
it's a cultural thing because I have brothers-in-law the two are like in their 40s, and these guys they're gambling fools. I mean,
Yeah.
these gaming apps, I think it's all the same. I don't think there's much difference between Robinhood and the gambling apps. It's, you know,
It's very similar. Some of these brokerages or trading platforms, sorry, I'll just say that, have been gamified where you get points if you trade enough, and those points give you $5 cash back, and you get a new little image on your portfolio. I'm like, that's a video game app. So, because they're trying to give you as much dopamine as humanly possible. So you're just like, I gotta
wow.
trade, I gotta trade, I gotta trade. I go like, and I was just thinking, because I was looking at one, I'm not going to name them, and I was looking at the trade platform. I was like, because I used to do mobile app development. And I used to do monetization for mobile app development. So the whole purpose was how do you keep people playing the game for as long as humanly possible and buy things in the game and watch the ads in the game and just keep them hooked because the longer they're in the game, the more you can sell them stuff. I'm like, these trading platforms, the ones I'm looking at, have been monetized and gamified the exact same way to maximize dopamine release. I'm like, technically this should be illegal.
Wow.
I was like, this should all be real. I'm like, why is this not regulated? There's already so much compliance when it comes to the financials. I'm like, how are they not regulating this? Is it, oh, I guess they're okay with everyone just foolishly spending their money because they're trying to get you to, and it was all centered around impulse buying, impulse buying, impulse
Oh
buying. I'm
yeah,
like,
yeah,
eh,
yeah. Wall Street is not your friend.
yeah,
They they have become extremely, extremely good marketers. And
yeah.
they've brought in people who know how to identify and hit the hot buttons. Um, and yeah, so it's a cultural thing, I think, to an extent, um, because everybody's gambling, everybody's doing this, everybody's doing that. And I think what's going to happen, because I can't tell you how many subscribers I have who came to us after the tech wreck and they said, I lost almost my entire portfolio because I was invested in all these dot coms. And, you know, and now I realize that that's, that wasn't real.
Yep.
And so, so we have a generation of investors that was formed by 1987. You have a generation that was formed by the tech wreck, generation that was formed by the Great Recession, the financial crisis. And I'm willing to suggest that this generation, with the apps and gambling or whatever, they're going to have their crash and burn moment. And then they'll go, oh, wow, I just lost a lot of money.
It's a
Yeah.
generation that learned to invest with a bunch of bad habits
Yeah.
and they're about to get a reality check. It's like, it's imagine if you just got in a car and started driving and you're like, I know how to drive. No one told you how to drive. You started driving, and eventually you hit a sign pole or you get in a car accident. You're going, how did this happen? It's like no one showed you how to drive. You were just willy-nilly driving, going fast, thinking you were good at it. You had no idea driving. You have to stop at stoplights. You have to shoulder check. You have to do all these different things in order to not hit other vehicles. You have a generation of people just driving around aimlessly with no direction and don't even know how to drive. They're going to eventually get into a crash, market crash in this scenario, or something bad's going to happen. And that's sort of how I see it sometimes.
Yeah.
But all we can really do is, and the reason I think I get back to why I was so focused on people being like, can you please pay attention to this podcast, is because I think a lot of the information in the investing style that you do, and it's iqtrends.com, guys. It's in the description. It's in the first pinned comment, right? You can check it out. I feel like it just stops people from making learn what you're doing, learn what Kelley's doing. And if you still don't want to do it, don't do it. At least know that this is an investing style that leads to long-term success. And if you're still like, I don't care, give me money now, great. But at least you need to know that these are the fun. And then I'm like, all for it, go for it. I just don't like it when people don't even know that like this is how it's supposed to be done. And they're just doing it because they entered in 2020. They thought it was just a giant video game. And that's just not what it is. It's a business, like you mentioned. Treat it like a business. It requires research. You have to have discipline. So like, hopefully you made this far into the podcast. Go to iqtrends.com, figure out, read the books. Both books are easy to find on Amazon. It takes 2 seconds to type in the title to find it. Dividends Don't Lie, Dividends Still Don't Lie. You can see it. Like I just feel like this is, I don't know. This is a podcast I just want most people to listen to so they don't make dumb investing decisions. And then they can go off and do whatever they want to do. Like I have some silly investments. I do higher risk stuff, in my opinion, like covered calls. I have all that. But I know at least like value investing. I have a built up portfolio that's fun. I can actually afford to lose stuff and try risky things because I have retirement and everything already set up doing this investment style. I can take risks because 95% of my portfolio is what we just talked about today. I have 5% allocated towards covered calls or whatever else I'm doing.
Covered calls are rational. That's not high risk.
They're in Canada, they're highly exposed to a market
Naked
crash
put.
because they put in puts in place, to minimize that, but they're still using 25 to 33% leverage. So, and then they still, they don't really capture the upside when something's doing well. They do take a lot of the downside. Like there's stuff there, but I can do that stuff because at least I'm rooted in the fundamentals, so I can go into that area and make videos about it. And I just feel like before you do that stuff, at least understand this part of investing, so you at least know what you're doing. You know the risk you're taking. I don't know. That's just like my PSA for everyone watching. I'll wrap it up because I'm just so happy we made it this far in with all. People don't understand the technical difficulties we have to do get this up and running today. So I'm just really happy that we did this. So I'll wrap it up. Can everyone find you at iqtrends.com? Anywhere else you want people to go, or do you or what do you think?
I don't really do social media. I'm old.
Fair enough then. Fair enough.
I'm a baby boomer, so iqtrends.com.
Check out iqtrends.com. Kelley Wright, thank you so much for speaking with me today. I'm so happy we finally got this to work. Thank you.
No, my pleasure. I really enjoyed it. This was a lot of fun, and I'd like to do it again.
We'll talk very, very soon. Awesome.
All right.
Talk soon. Bye.